Hello and welcome. In the next 10 minutes, we're going to unravel the story of one of the most powerful institutions shaping our world, the central bank. We'll start with their origins as royal financiers journey through the gold standard, the Great Depression, and the age of inflation. You'll discover how they went from simple lenders to complex global powerhouses. And we'll explore the immense influence of the US Federal Reserve. Stick around, because by the end you'll understand exactly how these institutions work and what their future holds in our uncertain world. Let's dive in. The story of central banking begins not with complex economic theory, but with a simple need: money for war. Monarchs needed a reliable way to fund their armies and manage public debt. The first institution we'd recognize as a central bank, the Sveriges Riksbank, was founded in Sweden in 1668, but it was the Bank of England, established in 1694, that truly set the blueprint. Its initial job wasn't to manage the economy, but to finance the state by issuing banknotes backed by government bonds. As global trade boomed, these banks took on new roles, regulating currency, ensuring banks didn't collapse, and slowly transforming from the king's banker into the guardian of a nation's financial stability. By the 19th century, the world had a system for monetary discipline, the classical gold standard. National currencies were tied to a fixed amount of gold, and central banks were the enforcers. Their main job was to maintain this link, ensuring the money supply didn't outgrow their gold reserves. The Bank of England became the lender of last resort, a crucial concept developed by Walter Bagehot. It meant that during a panic, the central bank should lend money freely, though, at a high interest rate to sound banks to prevent the entire system from collapsing. At this time, a credible bank was one that kept its promises, and this principle of restraint defined monetary policy for decades. Then everything changed. The gold standard shattered after World War I, and the Great Depression plunged the world into economic chaos. The old, rigid rules were clearly not enough. Central banks had to evolve. The US Federal Reserve, created in 1913 to prevent bank panics, found itself at the heart of this transformation. The disastrous years between the wars taught a harsh lesson. A central bank could not just focus on the value of its currency. It had to actively manage the economy, balancing the fight against inflation with the need for jobs and growth. This was the birth of modern, flexible monetary policy. After the devastation of World War II, global leaders met in 1944 at Bretton Woods to build a new, more stable system. This new order was a hybrid. Exchange rates were fixed, but countries had some freedom to manage their own economies. The US dollar, convertible to gold at $35 an ounce, became the world's reserve currency. This put the Federal Reserve at the very center of the global financial system. Central banks were now coordinating on an international scale, balancing their own country's needs with their global obligations. But this system couldn't last. By 1971, the US ended the dollar's link to gold, and the world entered the modern era of floating exchange rates and independent central banks. The 1970s brought a new economic nightmare: stagflation, a toxic mix of high inflation and stagnant growth. The old theories weren't working. In response, central banks shifted their focus. They started targeting the money supply and later interest rates. The defining moment came in the early 1980s. To crush runaway inflation, Federal Reserve Chairman Paul Volcker jacked up interest rates to over 20%. The short-term pain was immense: a deep recession and widespread bankruptcies, but it worked. Inflation was broken, and trust in the monetary system was restored. This Volcker shock cemented the idea that an independent central bank's primary job is to maintain price stability, a model that banks worldwide would soon adopt. So, what does a central bank do today? Their core mission is still controlling inflation, but their toolbox has expanded dramatically. They conduct open market operations, engage in quantitative easing, and supervise the entire financial system to prevent crises. Their balance sheets have swelled to unimaginable sizes, sometimes blurring the line between monetary policy and government spending. More than ever, modern central banking is about managing expectations. They use transparency and clear communication to guide financial markets, because markets react not just to what a central bank does, but to what they think it will do next. It's a delicate balancing act of credibility and communication. In the global hierarchy of central banks, one stands above all others: the US Federal Reserve. The US dollar is the world's currency. It makes up nearly 60% of all foreign exchange reserves and is used to price everything from oil to international debt. When the Fed decides to raise or lower interest rates, the effects ripple across the entire planet, influencing capital flows, interest rates, and currency values from Brazil to Indonesia. The Fed's decisions, made by its Open Market Committee, are intended to manage US employment and inflation, but they effectively act as monetary policy for the entire world, whether they intend to or not. But the Fed isn't the only major player. The European Central Bank, or ECB, manages the euro, the currency for a massive bloc of countries. It's a unique experiment in shared monetary policy without a shared government, and it faces the constant challenge of balancing the needs of very different economies, from Germany to Greece. Over in Asia, the People's Bank of China is a rising force. It manages the yuan and its immense foreign reserves, giving it huge influence over global liquidity, and it's leading the charge in developing a digital currency. Together, the Fed, the ECB and the PBOC form the triad of power that shapes the flow of money around the world. The 2008 financial crisis and the recent pandemic pushed central banks into even newer territory. Traditional tools like interest rates weren't enough. They turned to massive asset purchases, known as quantitative easing, and even started directly influencing credit markets. In doing so, they're not just setting the price of money, but also influencing where capital flows. This has led to tough questions about their independence from politics. At the same time, the rise of cryptocurrencies, decentralized finance, and AI is challenging the very foundations of money and banking. Central banks are now racing to understand and regulate this new frontier to ensure it does destabilize the entire system. Looking ahead, the future of central banking will be all about adaptation. The forces of deglobalization, climate change, and shifting demographics are changing how inflation works, and old economic models may no longer apply. Central banks will need to incorporate new risks like cyber attacks and climate events into their thinking. The development of central bank digital currencies, or CBDCs, could fundamentally change our relationship with money and give policymakers new, powerful tools. Ultimately, in a world of growing uncertainty, the success of a central bank won't depend on its tools, but on its credibility, transparency, and its unwavering commitment to financial stability. And that's our deep dive into the world of central banking. Thank you so much for watching. If you found this video insightful, please give it a thumbs up and hit that subscribe button so you don't miss our next exploration. We love hearing from you, so drop your thoughts and questions in the comments below. Thanks again, and we'll see you in the next video.